So here's a great question that I've actually never addressed before, but it's also super important. And it's basically, how long do I actually keep my investments for? That is crazy, right? It's super important. And when do I actually make changes to my investment portfolio? Now, I'm known as the most boring investor on YouTube, probably the most boring YouTuber on the platform, okay? And I'm very proud of that because my investment strategy is so simple where my only rule is common sense. So I invest in a certain way that the only way I can basically lose money is if basically the whole world starts to burn and fall apart. And that's exactly what you want when you want to be a long-term investor. Because the game of investing is not about making changes, it's not about being super smart, it's all about staying consistent and waiting out all of the storms. And understanding that when things get difficult, look back in history and see all the other times where things got difficult and where those were points, key points to actually make you even more wealth. So in this video, I'll tell you my overall investment strategy, when I actually plan on making changes and when I actually make them, and how things are going for me so far. Now, as always, guys, do me a favor right now and smash the like button. It's free. Make it turn blue, and I appreciate it a ton because it helps a lot with the YouTube algorithm. Now, the first thing, guys, is what is my investment exactly? What is my only investment? I invest just into the S&P 500. And some folks say, Tommy, you're not diversified enough. That's pretty crazy. How could you only just have one investment, one index fund, okay? How crazy is that? Are you not worried at night when you go to sleep? The answer is no. Because when you actually start to think about what the S&P 500 actually is and what it symbolizes overall, I sound like a crypto guy when I say symbolizes, it means something. But no, when you think about it logically, what is the S&P 500? The Standard & Poor, okay? Well, it's the 500 largest companies in the United States of America. The United States of America is literally the richest, most powerful country in the planet, okay? Or on the planet. Sorry for the people that care a lot about grammar. And those 500 largest companies are obviously the most important in America. And those countries, they're not just only living overall in America, they also do business worldwide. You have Apple, you have Tesla, you have Google. These are all global companies. Microsoft, right? They're global companies that are involved in global markets. So guess what? If these companies go down in America, it doesn't mean they're not going to be doing okay in other parts of the world. And it's not just one company, it's 500 companies, okay? This is massive. This is big. This is ridiculous, okay? And they're intertwined in the entire economy. So the only way I can possibly lose money is if the US actually goes down overall. And if the US goes down overall, well, whether I'm diversified or not, you're also going to lose money too. We're all going to lose money. And if we go down, if the US goes down, guess what's going to happen to other countries that are also intertwined with us and we owe trillions of dollars to, okay? Well, they're also going to go down too, okay? So my strategy to invest in is selfish but very powerful one, and it's basically, if I go down, we all go down. That's how crazy this strategy actually is. Now, how much money does this strategy actually makes me? Well, you can usually tell how risky an investment is based on the return you're expected to make. Now, a risk-free investment right now, which might be, for example, a treasury note, is you lend the money to the government, and it's basically risk-free because the government can always pay you because they could always just print more money. Your money will be less valuable, of course, but they could just always print more money and pay off all the debt they actually have. That's why it's risk-free. You will get your capital back, but we do not guarantee it'll be worth the same amount of money. That's the idea, okay? So that's risk-free. And right now that pays about 4.70% or so. So if you put your money in the S&P 500 over the past 72 years or so, it's been making roughly between 10 to 11%. That's what you're actually making. It's not really that risky. It's not really that crazy of a return because you're not making that much money because you're not taking on that much risk. And I love to use this rule. It's called the rule of 72 to actually calculate how long will it actually take me to double my money with the S&P 500. Well, you grab 72, you divide it by 10, which is like the average return overall. Some folks use 8%, but that's not really that much accurate because they want to discount like inflation and this and that. But for the most part, it's been around like 11.53%. But I'm using 10% to be like a little bit more conservative. So divided by 10, That tells me it takes me 7.2 years to actually double my money. So if I invest $1,000 in roughly 7.2 years, I will go ahead and double my money to $200. That is the idea. Roughly every 7 years or so, I'll double my money. That's pretty impressive, honestly. It's not that bad. But if it was actually a much riskier investment, I would expect to double my money a lot quicker. Like Warren Buffett, for example, he picks stock. It takes a lot more skill. It is a little bit more risky, but it doesn't mean that is as risky as it would be for me because I wouldn't know what I'm doing. But he makes about 20%. Do you know what that means? It basically means that if you grab this, 72 divided by 20, that's around every 4 years, Warren doubles his money. That's why the guy's worth as much money as he actually is worth, okay? But that's the idea. It's a very powerful thing. So how much money do I actually make per year, an average from the market? About $33,000 or so. Sometimes I make more, sometimes I make less because it might go down, it might go up. But one thing I understand overall about the market, that it's kind of like a roller coaster. And that's pretty impressive too, right? Because if you think about it, a roller coaster, what's the key? The key is not to the key, I'll tell you the key right now. I'm not going to use this whole example. The key is you don't jump off the roller coaster. That's the key. You will have ups and downs. That's a part of the roller coaster. If you jump off, you're screwed. That's what you don't want to do. You want to stick on the ride. So yes, the market's going to do this sometimes, but you just don't want to jump off. You want to keep staying in and making sure you're solid. So it makes me about roughly like $33,000 a year. Now, under what circumstances would I actually be willing to change my investment strategy? It's tricky. It's a hard question to ask because I wouldn't switch my investments if the value goes down tomorrow by 50% or even, for example, 90%. Why wouldn't I switch it? Okay, because here is a powerful Warren Buffett quote: "Price is what you pay, value is what you get." If I am invested into the S&P 500, the 500 largest companies in the US, and for the most part, almost in the whole planet, if I'm invested into them and the market crashes for some reason by 90% tomorrow, but the companies are still producing money, they still have employees, they still have a lot of customers, they still have great products, a great future, and overall everything mostly seems fine, for the most part things are just being exaggerated overall, the answer is I'm not going to sell my investments. I'm probably going to buy more because I see an opportunity. However, when would I actually make changes? Well, let's say, for example, the US goes under like some type of like new ureme or something like that, okay? Or there's like a dictator, or like there's a war, and then we basically lose and then we're being invaded. Those are some crazy things. But again, at that point, would it even make sense for me to sell my investments? Like where would I put them? Okay, like they're still in US currency. So the point is, this strategy is so powerful that when the ship sinks, it doesn't even make sense to change the investments. That's the idea. But when it's sinking and it's just like a false alarm, you're supposed to take advantage and put more money into your investments. But there is one more reason that I would actually change my investments. And the reason is a simple one. It depends on how much money I actually have invested. Now, let's use a short example here. Let's say I'm planning to invest for the next 30 years, right? So 30 years. And I calculated for you guys that basically I double my money about every 7.2 years. Let's just use the number 7 for fun, okay? So every 7 years, I double my money. So divide this number by 7. It means that in about 30 years, I'll double my money about 4 times. Now, if I'm making $33,000 a year, and I can basically make double that, right? Well, 4 times that in about 30 years or so, that's going to be around $132,000. Now, if all I really need to live is $60,000, and I get to a point when I can make $6,000 from investing into a risk-free investment, for example, like treasury notes, then I would basically grab my money and potentially put it into treasury notes. If it actually offsets the taxes and also the inflation. Let me not confuse you guys, okay? What I'm basically saying is this: if I'm able to put my money in a risk-free investment like a bond for the US government, and it pays me the exact amount I actually need after taxes and inflation, I would make that investment in a heartbeat. Because that way, I wouldn't have to be worried about, for example, the S&P 500 going down or going up. I wouldn't have to worry about all those roller coasters anymore. So those are the only 2 ways I would switch my investments. One, it wouldn't make sense because if the whole world is falling apart, the money doesn't matter anymore. And 2, if I have a lot of money, then putting it, for example, into a low risk investment is just like a no brainer. Because I wouldn't be worried about making more money. I'll be worried about making the money I need to make and just having that money come in. That's the idea. But guys, that is it. Those are my rules when it comes to selling, changing, buying my investments. That's basically it. It is super common sense for me. Now, I know you're probably thinking a few things. Tommy, where do you invest? With who do you invest? What is your strategy? Okay, I invest with Vanguard, and my only investment is into the S&P 500 by Vanguard. I do ETFs, but I also do index funds into my retirement accounts, and that's basically just about it. Now, my whole strategy is basically the financial freedom steps. Okay, I have a link down below to that course. If you want it, go get it. But that's the overall idea, because investments are great, but you also need a personal finance plan overall, because it's not enough just to be invested and do this and do that. It's not enough, because you want to make sure that if your investments go down tomorrow, you're still able to be solid. And that's what I look forward to when it comes to my investment plan. But guys, thanks for watching. As always, like, subscribe, hit the bell so you're notified. And fun question here, how much money do you need to make every single year to be solid, to not worry about money anymore? Comment down below, let me know. As always, this video is actually made possible by our supporters over at Patreon. And here they are right here. If you want to join us on Patreon and be sponsored or shout outs every single video I usually post, the link is down below. Join us on Patreon.